The Fed will be watching today's jobs report very closely because it has implications for their next rate hike decision. And given the tumultuous ride stocks have taken in the past few weeks, knowing what the Fed will do with rates can help protect your portfolio. So let's dissect the September 2025 jobs report and translate it into actionable portfolio strategy. The numbers are in and they're sending a mixed but cautionary signal. Let's start with the headline number, non-farm payrolls, or NFP. It's a measure of the total number of jobs added in the U.S. economy. It's both full and part-time across various sectors excluding farm workers. In fact, since the beginning of the year, job growth has averaged only about 135,000 per month, much lower than the average of the past decade, which is roughly 185,000. This raises two critical questions. 1. Are we seeing a structural shift where fewer jobs are being created? 2. Is this just a cyclical slowdown that will eventually bounce back? We simply don't have an answer yet. But it's essential to acknowledge this headwind, because persistently weaker job creation could have significant implications for consumption, inflation, and ultimately the trajectory of interest rates. A bright spot in today's report is that July's number was revised up by 20,000 to 73,000 jobs added, signaling resilience in prior months. However, it's somewhat offset by a downward revision to June. Overall, the 3-month moving average has remained relatively stable, suggesting some underlying strength in the labor market. But it's still substantially below pre-recession levels. Now, another piece of good news is that the unemployment rate ticked down from 4.2% to 4.1%, which is near a 50-year low. This indicates that those who are actively seeking jobs are finding employment, leading to a smaller pool of unemployed individuals relative to the size of the workforce. However, beneath this positive surface, there's a warning sign that the Fed will be reluctant to ignore. The labor force participation rate, which represents the percentage of the working-age population that is either employed or actively seeking a job, rose slightly to 62.8%. This increase might seem like a positive development. After all, more people are participating in the workforce. But the reality is that it's still near a 31-month low. This suggests that many potential workers remain sidelined, possibly due to a lack of opportunities or other personal circumstances. The rise in the participation rate is likely driven by those who had no choice but to join the workforce, rather than by an increase in available jobs. When we examine the broader picture, including those who have given up looking for work, the employment-to-population ratio, which measures the percentage of the workforce that is employed, paints an even bleaker picture. It currently stands at 60%, which is close to its lowest level since the Great Recession. All this means that the real unemployment rate, which takes into account discouraged workers who have given up searching for jobs, remains elevated around 7.5%, and that's a number that policymakers cannot ignore. Average hourly earnings play a pivotal role in the Fed's rate decisions because they offer insights into wage pressures and broader inflationary trends. Today's report showed that wages rose 0.3% month over month, matching expectations, but cooled to a year-over-year growth of 3.7%, which is lower than the 3.9% in July. This moderation is generally positive news because it indicates that wage inflation, a key component of overall inflation, is easing, which may alleviate concerns about persistent price pressures. However, while the wage growth is cooling, it's still high enough to raise concerns about sticky inflation. When wages rise, businesses often pass those increased labor costs onto consumers in the form of higher prices, potentially contributing to a wage price spiral. Even though today's numbers are a step in the right direction, the Fed will be closely monitoring wage developments to ensure that they continue to cool and do unsignal underlying inflationary pressures. One of the most concerning aspects of today's jobs report is the downward revisions to prior months' data. The data for May and June were both revised down by 258,000 jobs each, signaling a deeper softness in the labor market than previously reported. These downward revisions suggest that the economy might be in a weaker state than previously thought. They indicate that job growth in recent months was not as robust as initially estimated. This development is particularly worrying because it highlights a potential for further economic downturns or slower growth. The fact that 2 consecutive months were revised downwards suggests a consistent and considerable underperformance in the labor market. This trend is in line with observations of a broader economic slowdown. And for investors, it underscores the need for caution and adaptability. As we move forward, it's crucial to monitor these indicators closely. Downward revisions in job numbers often serve as early warning signs of broader economic challenges, and it's imperative to adjust strategies accordingly. A deeper look into the details of the jobs report reveals a troubling trend in the manufacturing sector. Over the past 3 months, manufacturing has been losing jobs with a total loss of 36,000 jobs in August alone. While this contraction is alarming as it mirrors similar job losses observed in previous recessions. Such a decline typically signals a weakening in both domestic demand and production. Moreover, the International Monetary Fund recently downgraded its global growth forecasts for 2023 and 2024, citing tighter global financial conditions and geopolitical tensions as reasons for the dimmer outlook. If the global economy slows, U.S. manufacturers will face reduced demand for their products, both domestically and internationally, resulting in further job cuts. Another cause for concern is the future of retail hiring. According to preliminary data from the Labor Department, employers plan to add only 1.1 million workers in August, which is the lowest level in almost 2 years. If this trend continues, it could have far-reaching consequences for the economy. When retail giants like Walmart and Target reduce their hiring targets, it's a clear indication that they anticipate slower sales growth. This cautious approach to hiring is likely a response to softening consumer demand and growing economic uncertainty. In fact, a separate report from Bloomberg revealed that retailers are now closing stores at the fastest pace since the onset of the pandemic. The combination of fewer jobs and store closures sends a worrying signal about the health of the consumer sector, which accounts for a significant portion of the U.S. economy. If consumers pull back further, it could drag down corporate profits and contribute to a broader economic slowdown. Now, it's not all doom and gloom. There are some bright spots in today's report. For example, the leisure and hospitality sector added 46,000 jobs, mainly in accommodation and food services. However, a closer examination of these numbers reveals a more nuanced picture. Within the services sector, leisure and hospitality saw the largest gains. But much of this was driven by seasonal factors such as summer tourism and vacations. Similarly, the professional and business services sector, which includes employment services, often sees fluctuations based on temporary project-based work. Therefore, while these sectors are performing well, it's important to consider the underlying trends and not solely rely on month-to-month variations. Furthermore, within the manufacturing sector, there was some positive movement. Construction saw an increase of 11,000 jobs, indicating that infrastructure projects and housing developments are continuing. This could be a positive sign for the sector as construction often leads indicators of economic recovery. In conclusion, today's jobs report presents a mixed bag of data points that collectively paint a cautionary picture of the current state of the U.S. economy. While certain sectors like leisure and hospitality are showing strength and average hourly earnings are cooling as desired, the overall trend points to a labor market that is softer than anticipated. Declining manufacturing jobs, downward revisions to previous months, and a concerning retail sector all signal potential challenges ahead. What does this mean for your portfolio? Well, here's how I'm adjusting my strategy based on this report. First, if you're holding growth stocks, especially in tech, consumer discretionary, and REITs, today's report brings good news. The slight easing of inflationary pressures and the possibility of a delayed rate hike will benefit these sectors. These companies often see increased valuations when interest rates are lower or expected to be lower. So consider adding exposure to these areas. As a hedge against potential volatility, consider holding long-duration treasuries or gold, which can serve as buffers during times of economic uncertainty. Second, if you're overweight cyclicals, particularly in industrials, retail, and travel, today's report suggests a trim is in order. Weaker job growth and a softer labor market may impact consumer confidence and spending power, which will directly affect these cyclical sectors. Consider rotating some of your holdings into more defensive sectors, like healthcare and utilities. Third, if you're seeking stability and are overweight in bonds or defensive sectors, Today's report suggests staying the course. Volatility is likely to spike given the report's mixed signals. Your portfolio's diversification and focus on quality should help navigate these choppy waters. Continue to monitor PEG ratios, especially in the retail and manufacturing sectors. If earnings estimates start to decline, it might be time to lighten up on certain positions. Protective puts can also be considered to shield against potential downside risks, and it's crucial to monitor earnings revisions closely. A downward trend in earnings estimates, particularly in retail and manufacturing, could signal challenges ahead. Lastly, keep a close eye on what the Fed says and does in response to this report. Non-farm payrolls are a key consideration for their rate decisions. Additionally, observe how the bond market reacts to the jobs report. Significant shifts in Treasury yields can provide insights into market expectations regarding future rate hikes. In essence, today's jobs report reinforces the need for vigilance and adaptability in our investment strategies. By closely monitoring key indicators, understanding evolving market dynamics, and remaining diversified, we can position our portfolios to weather the uncertainties that lie ahead. Stay safe out there. And if you enjoyed this video, give it a thumbs up and consider subscribing. Your support means the world to me. Thanks for watching and happy investing.